Good morning, everybody. How's everyone doing? My name's Chris. I am the founder and CEO of Credit Cooperative, Credit Coop for short. And today what we're going to do is walk through how we view payment flows as collateral and follow the money through that transaction. So as we think about what's going on in the world of payments, there's a lot of exciting developments. The most important thing that we're really monitoring right now is stablecoins being used for payments and stablecoin settlement. So when a payment company, whether they're a card issuer, a merchant acquirer, or even a remittance company, uses stablecoins for payments, these all settle in seconds, settle nearly in real time. They're cost-effective, sub-cent to do a transaction, and again, real time. On the right-hand side, you'll see what actually happens, though, in the fiat world. So despite Visa using stablecoins for settlement, they still pay out in fiat to a lot of different participants in Visa network. That takes 2 to 5 days, depending on where you're at, and the same thing applies for MasterCard. So if you're a payment company, how are you going to bridge that gap between an instant payout and not getting paid from your merchant or from the network 2 to 3 days later? And they use their own capital, or if you're a bank, you'll use deposits to kind of fund that gap. And if you're a non-bank issuer, it gets very severe because your idle capital is just locked up. And that's what this slide shows, which is, well, where does that money actually go and how does it just stop flowing? So if you're a non-bank issuer, on the left-hand side is just a column of the daily volume that you're processing. So what we've shown here is the darker the purple on the right-hand side, the more manageable this would be. So if you're a payment company doing $1 million a day with Visa Network, you're probably locking up $2 million, at least, just sitting idle, in cash, not earning anything, for the ability, right, to issue cards and process payments. You can imagine how that gets very strained on a balance sheet for a startup who's not a bank. Imagine $100 million a day, that's $200 million locked. So they need to find that capital somewhere, and that's where Credit Coops comes in. Otherwise, their growth is really limited to their balance sheet. Outside of that, we have a few interesting things that are happening that are making more companies, specifically non-banks, use stablecoins in their settlement. We see 4 main forces. The first one would be the clarity that we're getting from regulators. So in July of 2025, the Genius Act was passed. And more recently, we've had some exciting developments about, well, how will we actually implement that in the markets? So the OCC in America, which regulates all the banks, about a month ago, they put out a request for comment about how they can implement the Genius Act. So we're getting much closer to that being law. The other thing that happened is broker-dealers who facilitate trades in the markets, they used to have to haircut any stablecoins on their balance sheet by 98%. So you can imagine the impact. If you're a big client and you want to settle with your broker-dealer, they're just going to say no. About 3 weeks ago, that changed. So instead of a 100% haircut, it's only 2%. So if they have $10 million on their balance sheet, they can value that at $9.8 million. A year ago, that was $0. So effectively, they prevented that market from growing. The second element that we see is just continued momentum in the data of number of transactions, total volume, and we're getting to a point where this is at scale. So Stripe, last year in their annual report, they announced close to $2 trillion in stablecoin payments, 1.9 to be exact. Another company in the space called Slash, they're a Visa issuer, and they issue cards globally and do payouts. They processed $4 billion last year. This is all on stablecoin rails, so this isn't a new thing. The third and fourth points that we see are a global macro trend of private credit as banks retreat from asset-backed financing and securing loans with receivables. A lot of that's regulatory driven, and we're seeing private capital really over the past 2 decades, this isn't a new trend, grow their private credit AUM. So that's from Apollo, Blackstone, Ares Capital, even KKR, who historically is a private equity firm. In 2024, they raised more private credit than they did private equity. I think that's a sign of the markets. And then the last thing that we see here is some independent validation from external parties. So whether it's Visa Network writing about stablecoins and their settlement, or more recently, there was a post, you guys should check it out, by Galaxy Ventures. It's called The New Age of On-Chain Credit. And what they do is they talk about this trend of programmable money, secured lending with receivables. And they specifically highlight one of our borrowers, Rain. They're a card issuer, principal member of Visa, and Credit Coop, and the work that we've done together. So we've built it, they've named it, and now it's about scaling the platform. So how do we actually secure a receivable and do programmatic finance on chain? We have a smart contract called the Spigot. And what the Spigot does is it controls that cash flow. So before any disbursement happens to a payment company, that borrower must transfer ownership of their smart contracts that facilitate the money movement to the Spigot. What that allows us to do is, in the top right corner, programmatically route that payment flow from their address to the line of credit. And this is really important for lenders because it removes the trust. So it enables automatic repayment, and most importantly, the borrower doesn't touch it. They have no discretion on repayment. It flows automatically to the Spigot and then to the line of credit. The most important thing here is certainty for how this can be enforced off-chain. And in the United States, 25 out of the 50 states have adopted Article 12 of the UCC, Uniform Commercial Code. And most excitingly, for Credit Coop and for borrowers, this is a new way to secure your loans. It's actually a super senior position by control. So instead of doing a paper filing or logging into a government website, borrowers now are able to transfer ownership in a click of a button. And a lender can perfect that interest by the control, therefore preventing others by having a competing claim. And then the last element here, given everything settles on the blockchain, we have real-time monitoring of any risk that occurs. So at Credit Coop specifically, we look at what we call a Spigot repayment rate, SRR. We also look at debt service coverage ratio and liquidity duration. This is all made possible by real-time payments, settling on blockchain, and the data that we get as a result of it. So, what does this actually look like in practice? On this slide, we can see a payment cycle. So on the left-hand side, there are cardholders like you and I. We make payments, we buy coffee, we go to dinner, and if you use a stablecoin, that happens instantly. And the reality is, on the right-hand side, step 5, you don't have to pay your bill for 30 more days if it's a credit card. Steps 2, 3, and 4 is kind of the card issuer trying to figure out what I was talking about earlier. How do I fund this? Right? I've got 30 days, or if I'm halfway through the month, I got 15 days remaining. And that's where we come in. So the Spigot, step 2, actually will secure that repayment when it happens 30 days later. And we route that to the Credit Coop vault, which is continuously advancing USDC, for some borrowers globally USDT, to those payment companies for settlement. And then as they get paid from their cardholders or their users in fiat, that's on-ramped and continuously flows through that smart contract. So it's a revolving facility. It's not like a term loan. Step 4, the borrower, the card issuer, the merchant acquirer, or the remittance company now gets that USDC and can scale higher volumes. And this process continues every single day. It takes about a second. On Solana, it's less than a second, 200 milliseconds. On Base, it's 400 milliseconds. On Ethereum, it's 12 seconds. But it's many multiples faster than traditional finance. When we look at our platform, because this is very short duration and continuously revolving, on average, our loans are only outstanding for 3 days. Now, again, the reality is they continuously revolve, but if you were a lender and wanted to remove, you could be repaid in about 3 days. So the capital is always turning. And what we've seen is a really accelerating trend in 2025, and it's not slowing down in 2026. So what these flows have revealed to us is that, number one, that payment flow actually is the collateral. So on the bottom row here, we have some of those metrics that we look at. For those of you from like real estate finance or even the traditional credit world, you're probably used to seeing a coverage ratio of 1.25, 1.5, 2x for really good borrowers. The reality is these payment companies are great borrowers. They can cover their obligations many times over because of how short duration this is. And if you look at it, we've got close to 45, 46x coverage ratio. That's the legal maturity. Spigot repayment rate is, let's do the same math, but let's look at the past 31 days. So a moving, trailing 30-day average, still 15 to 16x coverage. And this, as a result, has led to no defaults on our platform. We've processed $1.4 billion, and that rate is accelerating into 2026. We're doing about $250 million per month, and this is not Credit Coop. This is our borrowers running really good businesses. This is our borrowers having more emerging markets that they enter. This is more cardholders signing up. This is more merchants accepting stablecoins, right? That's not us. Without our borrowers, there's no thing to lend against. So as their demand increases, our volume also increases. Where are we taking this and kind of how will this evolve over the next year? We're really excited about it. And on the right-hand side, you can kind of see where we're at today. Secured credit, all these different payment companies. In about 3 months, we'll be launching our Vault product and opening that up to the public. The receipt token is called CCUSDC. If you guys are familiar with Maple and their token Syrup USDC, it's akin to that. So think of it like a vending machine. You put USDC in, you get CCUSDC back, and then that is allocated to the payment companies and continuously revolving. Later this year in Q4, we'll have some DeFi composability and start integrating CCUSDC with money markets on chain, such as Morpho, such as Aave, using that as collateral to do some leverage looping. And what I'm really excited about is integrating this on Pendle, so marketplaces where you strip the principal token from the yield token. This is what we're building, and then in 2027, as we scale this network, we will be opening up our liquidity network really to every payment company globally, every depositor globally, and we have a saying here, use the network, own the network. And for the crypto people, I think you have a pretty clear understanding of what that means, and that'll be in 2027, so we're pretty excited. Wrapping it up, I would say summaries are 3-day duration, super short duration. Even money market funds will have 1 to 3 months of exposure to T-bills. We're many multiples less than that. We've had no defaults. The payment flow serves as the collateral itself. This isn't theoretical. This is in production and has worked for 3 years. And our expectation is, despite the rapid growth in 2025, we'll see even more in 2026 and 2027. Some estimates say 30x from where we're at today. We're going to take a more conservative one and say 10x. What that means is networks like Visa are settling anywhere from $3 to $4 billion annualized in stablecoin flows. We could see anywhere from $30 to $40 billion of settlement from stablecoins on Visa cards just in 2026. So that's really exciting if you think about where those networks are at in fiat. And just to put that into perspective, they do about 15 trillion. If you include Visa and MasterCard, we're at 25 trillion. So we have a lot of room to grow here and a lot of efficiencies to bring to both banks and then non-bank issuers in this system. So for those of you in the room who are payment companies or borrowers, we'd love to chat with you. I think every single payment operator in this space will need a wholesale credit facility, and Credit Coop serves as that backstop. If you're a lender and would like to make secured loans, we'd love to talk with you and have you in our private beta before we open up the Vault product. That's all I have for you today. Thank you, guys.